Studies minor from Louisville, Kentucky.
All right, good afternoon. My name is Jamari and I'm a first year 5 MBA major leadership studies minor from Atlanta, Georgia. And today, me and my partner Langston have the privilege of trying to gain your trust. For too long, the stock market has played games with your mind, and it's time to make a stop.
All right, a brief overview. All right, first we're going to present you the background information, the issues at hand, and the effect on how your money and other investors are affected, the advantages of big companies that they have versus, the investors as in you guys, the actual process that the high frequency trade market has, and the comparison of the two stock exchanges. There's not just us, there's of course globalization between all the rest of the exchanges. Also 21st century New York Stock Exchange, and also the connection between our scenario and the leadership situation we are currently in. The New York Stock Exchange was established on May 17, 1792 with 24 stockbrokers. The New York Stock Exchange went public and it also went electronic in April of 2006. It merged with the Archipelago Electronic Stock Exchange shortly after, which helped form one of the largest stock exchanges globally. Also in 2008, the New York Stock Exchange inducted the American Stock Exchange, which was a lower stock exchange, lower than the New York Stock Exchange. Issues at hand. Now that technology has become a bigger, larger part of our community, it has become a larger part in also the trade market. It has taken over a lot of our investments and also our trust banks. It provides a negative profit back to the investors, such as us and your parents. For example, like your college funds and other, retirement funds that they have. Also, it's created a fast money market, which is also a negative profit back, again, to us as investors. And then computers are able to run a front run, which I also will explain in the next few slides.
Okay, you give me a history.
All right, so now we're going to focus on how we, the people, are affected, or investors. So when you do depend on these high trading frequencies, or HTS, you lose a lump sum or amount of capital. So when you put your money into these systems, basically what happens is these computers are foreshadowing or predicting exactly the moves you're going to make, and they make them before you make them. So let's take an example. Say you guys and all your friends, we're going on a spring break trip, and we're going to StubHub, and we get roughly around 30 tickets for about $50 a piece. So what this company does, what these high trading frequencies do, they basically take that number and inflate it. So what they do is they lessen the stock and up the price. So now we have 20 tickets at the price of $100, and when we go back and try to buy more, those prices are inflated.
I'm glad y'all look at 60 Minutes like I did.
All right, the advantages that big companies have. First, the first accounts of high frequency trading occurred in 1998.
All right, and one instance was the Bank of America incident. Billions of dollars were lost. So basically what happened was Bank of America basically front ran. And what this was is that means that they put out a number of stock and another company bought the stock. And by the time they sold the stock back to Bank of America. When they sold the stock back, it was inflated at a higher price, so in turn causing Bank of America to lose money. Also, we have Goldman Sachs. Now, they ran a aluminum scam. So what it was is that first, people got aluminum, big companies, people got aluminum in usually 6 weeks. Now they expanded to a 16-month trial where a big tax wasn't enforced. So basically they held your aluminum and they taxed you according to how long they held it. And finally, we're going to wrap up with NASDAQ, which a lot of us are familiar with. If you scroll on your iPhone, the stocks pop up and NASDAQ pops up. So we took an answer from Professor Jarvis and said the early bird catches the worm. Now with NASDAQ, they basically had a scam where the high trading frequencies could basically pay NASDAQ to foresee what they were going to put out. So for example, that is basically seeing what the company was going to do before they did it.
All right, Now I'm going to explain to you the actual process, and I'm actually going to draw a visual to help you visualize how the actual high frequency trade market occurs. Okay. Okay. So, like I firstly stated, the stock market trade is sent to a large high frequency post owned by a large company. So say the New York Stock Exchange is here. Then it is sent out and it's analyzed by computerized, it's basically high frequencies under fiber optic cables. So they're sent out to all of these other small investments, and then next it is sold to the investors like me and you or our parents, which would be down here to be us. But the catch here is, by the time it gets to us, the price is pretty much inflated. Because by the time it gets to us, not only are large companies in competition to get these stock shares, they're also the computers are also raising the prices, and they're also selling them back to you for you not able to gain a profit at all from your stock shares.
Now, Langston, now you know they really didn't understand what you said, so I'm going to break it down a little bit further.
Okay.
So let's say that you guys, we're all one big company, and we own 10 million shares. Now, we're going to sell these shares at around $10 a piece. So let's say Professor Jarvis is his high trading frequency with all these smart algorithms and high frequency math problems. So he says he's going to buy these shares for $10.05 a piece, gaining a 2-cent residual on each stock. If he buys these stocks and sells them back, he's going to get a $200,000 gain from the original stock, which happens in milliseconds. So if high trading frequency repeat this process, it could cause $1 billion deficit, which happened to Goldman Sachs, which is why the credibility of high trading frequencies is now infringed upon.
I need to ask you a question, and what happened to Enron? We studied that.
Yes, sir.
How was their shares inflated? And the justification for the inflation, and that basically kind of went over. But if you can break it down in layman terms for the rest of the class, I would like for you to do that.
Okay. As far as Enron, they overstated what they actually made. So when you overstate stock, your company basically is putting out false values that you did not make. So when you put out false values, it's like the high trading frequencies. They show a glimpse of exactly what is supposed to be made and is not made. So they're actually tricking you to buy these high stocks when really it's a low number so that money can be regained.
Okay, continue.
All right. Jamari will be now representing the New York Stock Exchange, and I'll be representing the London Stock Exchange. So you can go ahead and explain the New York Stock Exchange.
I'll be Wall Street for you.
Okay.
So on Wall Street, trades occur on the floor level as well as through technology now, due to 1998 with the high trading frequencies. So now you're able to actually, the phone call, person to person, warm feeling that you usually get when somebody's trying to sell you maybe a penny stock or even interest you into buying in a company is now going to be obsolete. But there are high trading frequencies who take place in turn for these.
As for the London Stock Exchange, there's limited human interaction. It's all electronic, all technology now. Also, it consists of 2 core markets. The main market, which is composed of the larger companies, like he said, the NASDAQ, I guess Apple, Google, stuff like that. And then the alternative investment market consists of smaller companies, smaller firms. And then trades are on a contract for difference, which simply means it's a form of equity swap, which pretty much means money swap, trade swap, everything trading, pretty much that's what it is.
And on Wall Street, it's an auction process. So the biggest shares go to the highest bidders, which is where the high trading frequencies come in, because they sense these high trades. They see the trends that you do to buy these stocks, so they jump out in front of you and actually inflate these prices before you can even gather to them.
Okay, you're losing Hampton. Come on, break it down for me some more. How does the leadership actual challenge help you in seeking out the problem and getting a solution to the problem?
And you can skip right to down this week.
Okay, So what, basically the person that actually founded this was Brad, he was a
Brad
former,
what? I know that gentleman quite well, and it's significant enough for you to know his last name too.
Zach, I can't really pronounce it, it's like Zach Yami or something like that.
Sakayama.
Yeah. He basically was a perfect example of,
I could have said Colgate.
he was a perfect example of what he thought was the exemplary practices of leadership. Firstly, challenging the process because through all of adversity and all, he gave up his billion-dollar job just to find a solution to help Americans gain money.